Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alcon, and along with Brianna Valesky, and we have Jason O'Donnell on the line, Chief Investment Officer at Bluestone Financial Institutions Fund. Jason, how you doing on this Friday morning?
I'm doing well. How are you?
We're doing good. Give us a little bit of your education, background, in the markets, and how you ended up in your current position.
Sure. So I got my start on the sell side, doing sell side bank research about 13 years ago, and lucky me, they sort of handed me a mandate to cover banking institutions, which at the time seemed very much unsexy. But I think as I kind of dug into it, into 2 or 3 years into it, I kind of fell in love with the space, and I've been doing it ever since. And so we recently launched a hedge fund dedicated to banks, myself and my colleague Ted Peters, called the Bluestone Financial Institutions Fund. And we've been running that. We've had the strategy in place for a couple of years, and we've been running the fund. We've opened it to outside investors just a couple months ago.
Okay, and strictly on the banking and brokerage sector, huh?
Yeah, we're very specialized. We think the way that you make money in the U.S. equity markets, or one of the ways that you make money, is by being highly specialized, particularly in the U.S. equity market. And so we've dedicated ourselves to kind of trying to exploit the small and mid-cap bank space in particular. So we're very narrowly focused, and I think we've done a pretty good job of doing that thus far.
Okay, you've been credited with developing 3 major financial concepts specific to fundamental analysis of banking institutions: the failure ratio, success ratio, and core value. How did you go about developing those indicators?
Sure. So the failure ratio, was developed probably 5 or 6 years ago at a time when banking institutions were failing in large numbers, and so the old methodology, which was called the Texas ratio, wasn't working nearly as well as it did in prior cycles, largely because there was a lot of tier one capital in the system that wasn't present previously. So we developed that ratio to try and create a more accurate indicator of when institutions would fail. The core value and the success ratio are much more recent, developed in the last 2 or 3 years, and those are really designed to do quite the opposite, trying to identify institutions that were creating shareholder value in the space. And so there's a couple different ways that it's traditionally looked at, and the way that we do it is very unique.
Okay, moving on here, we got to talk about the big announcement today. What's your current view on interest rates and, the Fed fund rates specifically, and the data today? Is it going to make the Fed do anything different?
Yeah, I think the data today was certainly better than what we saw in March in terms of the employment report. So the April employment report that was just released about an hour ago was better than what we saw for March. The numbers in terms of jobs created came in at 223,000, I believe, for April versus consensus of 228. So largely in line. We're a little disappointed to see the negative revision to the March number. There was a significant revision from 126,000 jobs created in March down to 85,000. So I think the market's going to look at that and maybe pause a little bit. The labor participation rate improved slightly, but not enough to get people excited. So I think it was kind of a mixed bag, but certainly better than what we saw last month. As far as the banks go, what this means is it's on balance a good report for banks. And the reason being is that it kind of keeps us grounded in this notion that we're going to see rate hikes this year. Our current expectation is that the Fed funds rate is heading higher in the fourth quarter of this year by 50 basis points. That's our base case view. And as you're probably aware, the banks, or maybe not, for some of you out there, that the banks are particularly the small and mid-cap banks, are highly levered to interest rate increases. So as we begin this process, that means very, very good things for earnings growth.
And it doesn't necessarily mean an end to the bull market either, in your opinion.
No, I don't think so. I mean, I think that the market in the short run can react negatively to the idea that interest rates are heading higher and that economic growth, even as perverse as it seems, maybe getting stronger. But I think in the intermediate and long run, it's a good thing. I think we all want a healthy economy, and I don't know about you, but what I'm seeing out there is a U.S. economy that continues to improve. It's not improving by leaps and bounds. Sure, energy is in trouble, but I think the rest of the space, and probably supported by lower energy costs, there seems to be a lot more activity this year than we saw last year. We saw a negative 0.2% GDP growth in the advanced figure for the first quarter. But keep in mind, that was up dramatically over what we saw in terms of the GDP growth in the first quarter of 2014, which was negative 2%. So we're seeing kind of a very much a weather-dominated series of GDP data recently, but overall the trend seems to be positive.
Okay, small mid-cap banks wrapped up earnings season last week. How would you characterize the groups as a whole financial results, and do you think that the stocks reacted in kind?
Well, the earnings for the small mid-cap banks were very encouraging. We saw a number of names that were up. Some of them were up 5-10% off the news. Very good results, particularly when you consider that first quarter is the sluggish quarter for small and mid-cap banks, as it is for a lot of spaces. Organic loan growth paced in the mid-single digits, which isn't that exciting, but that was up from the low single digits last year. Overall loan growth for the year, we expect to pace somewhere around 10 or 11%. On an organic basis, we expect it to pace around 7 or 8%. So earnings are, if you look at it just on a pure earnings basis, and you put aside kind of the industry jargon, the EPS we think is going to be growing. Earnings per share is going to be growing somewhere in around 9 or 10% this year, and we expect it to accelerate. In the event we start to see higher interest rates, we expect to see your average bank grow earnings somewhere around 12 or 13% next year, which we think is very good, particularly when you consider there's a lot of banks. It's a very large space, and a lot of these guys that we're focusing on are growing earnings at 20 or 25% or more a year.
Okay, in light of the economic data we got today and the earnings, what's your updated outlook for small and mid-cap banks for the rest of the year, and what could be the potential drivers going forward?
Sure. So the bank market and the broader equity markets, as you know, have been relatively flat year to date, despite some significant volatility in January and February. We've lowered our overall return expectation to the high single digits from the low double digits in terms of overall return for this space, due largely just to pushing out the rate hike expectation. So I think earlier in the year we were thinking September we were going to start to see the Fed raise interest rates. Now we're thinking October, November, fourth quarter. We put it all together. We're looking for a space that's going to generate in the small mid-cap bank arena. We're looking for high single-digit, possibly low double-digit returns for that space this year. And as I said, we're looking for 50 basis points worth of increase in the fourth quarter.
Okay, all right. So last time you were on in January, you stuck your neck out on the line and you recommended some stocks, and one of them, Texas Capital Bank shares TCBI, is up around 25%. Still like it, or is it time to hit the exit button?
Yeah, I think Texas Capital is one that we would recommend lightening here. The revaluation of that stock has happened much quicker than we anticipated. Obviously, we're happy to see we own it, and we owned it, and we were happy to see the name revalue. But around $53, $54, we think it's fully priced in the recovery that we talked about. We thought that the sell-off in energy was overdone, and so that played out largely the way that we expected. There were some questions that emerged on the first quarter conference call around credit quality. We think Texas Capital is a fantastic company, but there were some questions that sort of implied, or at least some issues that implied, that credit expense could be higher than expected later this year. And we think just given the revaluation, it's probably time to take some chips off the table.
Do you get out completely, or do you just trim a good part of your position? How do you play it?
I think it relates really to whether what type of investor you are. So if you're an investor that wants to own quality long-term quality banking institutions for the long run, then I think you hold it, just given the tax implications of selling it, particularly if you bought it in the last 12 months. However, if you're not in that category, I would encourage you to lighten it or sell it outright.
Okay. Another one's doing okay. Ozark, Bank of the Ozarks here, and that thing's knocking on the door of the recent highs. I'm not sure if it's all-time highs too. What are they doing right over there? And where's your fair valuation on this one?
Sure. So we recommended Bank of the Ozarks was the other one that we recommended earlier this year, and the stock is doing well as you mentioned. I think the catalyst here was really a phenomenal quarter. This is one of those names that I mentioned earlier that had a kind of a 9 or 10% post earnings release jump. Very, very strong organic growth. We're talking 20, 25% loan and EPS growth. And they've got this whole bank M&A story that continues to move the needle. They recently announced an agreement to purchase Bank of the Carolinas based in Mocksville, North Carolina. It's a small deal, but again, it's keeping investors reminded that this is both an organic growth story and a whole bank acquisition story. And actually, I expect these guys to announce a major acquisition, an acquisition that's going to push them well above their current size for all kinds of reasons at some point later this year. And I think, given the valuation, which is pricey, ironically for these guys, because they're so pricey, because they trade at such high multiples on earnings and tangible book value, when they acquire another bank, it's highly accretive to their own franchise value. So I expect them to see a major deal announced from these guys at some point by the end of the year that really takes the valuation higher.
Okay. And how about the big banks? Can we talk to you about some of the big banks and big brokerage firms, or do you not really focus on them much?
Well, we focused on them to the extent that they're relevant to the banks that we follow. I mean, I think one of the things we paid a great deal of attention to earlier this year was when we had the round of a capital stress testing, DFAST and CCAR. We paid close attention to that, but certainly it's not an area of focus of ours. In fact, we think there's a lot of problems with that space. Besides the fact that the federal government has its hand in the wallet of most of the largest banks, we think that there's some issues from a litigation expense perspective that continue to drag on earnings power in that group. I think a lot of people sort of said to themselves back in July and August, when a lot of the final mortgage-backed security litigation suits were finalized, that this was the end, that litigation expense was going to be largely behind the group. The stocks are still cheap today relative to where they've been historically, and that there was going to be this catalyst. Well, we found out since, of course, that that's not the case. We've seen one set of suits after another continue. Foreign exchange trading has been the latest round. It's not a space that we view particularly positively.
Okay. All right. Any final advice for investors out there? I mean, big move up in the market today. Just seems like buy the dippers reign supreme here. Any kind of just a general outlook on the market?
I think our views in the bank space are in some ways relevant to the broader markets. I mean, if you look at what happened in January and February, I think the key is not to get too rattled. And so we saw a big decline, certainly in the banks and in other areas in January. And I think there were some folks that exited for fear of this continuing in February. We saw a major rebound. I think for those that got out in January, they were kicking themselves pretty hard at the end of February. So my advice is to stay the course. Look around you. Our perspective is that economic growth continues to improve. Kids coming out of schools are starting to get jobs at a rate that they hadn't in a number of years. Things are improving. It's slow. It's not great everywhere, but our view is just kind of stay the course and don't make any rash decisions should volatility reemerge later this year.
Jason O'Donnell, Chief Investment Officer at Bluestone Financial Institutions Fund. Jason, thanks a lot. Great insight on small caps, mid cap banks, the entire banking sector, and the market as well. Thanks for coming on. Have a great weekend. We hope to speak to you again soon.
Take care, guys. See ya.